Good afternoon, everyone. I'm Michael Wilson, the Executive Director of Wealth Management here at First Citizens. Pleasure to be with you today, along with, we have Brent Ciliano, our Chief Investment Officer, along with Phil Neuhart, Manager of Institutional Portfolio Strategy. I want to welcome you to the seminar series that we've had, which is designed to making sense of the markets. In our continuing efforts to bring you information surrounding markets, economic events, as well as policy changes, we're extremely excited to have you joining us today. While everyone's getting signed in, I want to share with you a few housekeeping items. Number one is that this webinar will be recorded. A replay will be available shortly after the call. Secondly, you'll have an opportunity to ask questions. Should you have a question during the call, please use the chat feature to submit your questions. All questions are confidential, only visible to myself as well as the other panelists. We will answer as many questions as possible during the webinar. And as a reminder, the information you're about to hear are the opinions of First Citizens Bank and are for educational purposes only. Should you have any concerns or questions regarding your individual information, please, we ask you to reach out to your First Citizens Relationship Manager. Thank you again for being with us today. We have a lot of information to cover. And with that, I will send it over to our Chief Investment Officer, Brent Ciliano, to kick things off. So, Brent, let me toss it over to you.
Great. Thank you, Michael, and good afternoon, everyone. Phil and I are going to break down today's discussion into two fundamental parts. First, we're going to do a deep dive into sort of the economic big four. We're going to discuss where we are in this economic recovery and what the important catalysts are that will make or break the path forward from here. Then we're going to talk about the ever-important U.S. consumer. And given we, as consumers, explain in excess of 72% of U.S. real GDP, as goes the consumer, as goes U.S. growth. We're also going to give you an update on where we are with U.S. corporate earnings and where that recovery is from the depths that we saw back in the second quarter of last year. This is going to be critically important if markets are going to make higher highs in 2021 and beyond, which we believe that they will. We're also going to discuss the path forward for rates and inflation and the impact rising rates might have on both your stock and bond portfolios. Plus, we'll also address the significant inflationary base effects likely in both goods and services from all of this monetary and fiscal policy stimulus. Lastly, and what all of you are most likely interested in knowing is, what's the path forward from here for equity markets? We're going to break that conversation down into two important time periods. First, from today through the end of 2022, maybe the first half of 2023, then from the second half of 2023 throughout the remainder of the decade, as our outlooks for those two time periods are significantly different. So without further ado, Phil, why don't you kick us off?
Great. Thank you, Brent, and thank you for everyone for dialing in. Let's jump first and just quickly into U.S. and global economic growth. So here in the U.S., not too surprising to anyone on the phone, we had a severe recession last year. It was the third largest contraction in history, far larger contraction than we saw in the great financial crisis of 2008, 2009, and the worst crisis we've seen since World War II demobilization from an economic standpoint. So really a major recession, and the largest recession most of us will remember. As we look forward, the recovery is intact economically on a global basis, but it is uneven. The IMF recently revised upward their global growth forecast for 2021 to 5.5%. In the U.S., we're looking broadly stronger. Manufacturing and services data has come in pretty strong in January. We received ISM manufacturing yesterday above expectations. But we are seeing a pretty slow labor market recovery. This Friday, we do receive non-farm payrolls, which will be interesting in terms of what we saw in terms of payroll growth in February. In Europe, it's a little bit more of a mixed bag than the U.S. We have seen further lockdowns. There is a chance of double-dip recession in certain geographies within Europe, but consumer spending is showing a modest lift. So a little bit more of a mixed bag in Europe. And then Asia is almost fully recovered. They were the first into recession, the first out. They are showing real growth. Places like China have data economically approaching pre-pandemic levels. So Asia is certainly the leader in the clubhouse at the moment. Back in the U.S., of course, the severity of the recession was the first half of last year. In the third and fourth quarter of 2020, we saw a snapback. That recaptured about 3/4 of the $2 trillion loss in economic output. We're still below the previous high in gross domestic product, as you can see here, but should reach those levels in coming quarters. That said, still have a ways to go economically. Looking ahead for this year and next year, the consensus expects growth in 2021 and 2022 to generate above trend. Trend since 1970 is about 2.8%, growth of 4.9% and 3.7% this year and next would certainly exceed that. As we look further out, 2023 growth is expected to be about 2.5%. So we're seeing a sharp rebound in the near term. Then as we look into longer term timeframes, trend could be below, growth could be below trend. So sort of it's a race to the below trend growth. Looking more recently or in near term quarters in the lower table, we are expecting some pretty sharp economic growth in coming quarters. That said, out years could certainly be slower. As we've been telling clients really for a year now, that the answer to all your questions is COVID. This recession was not a traditional financial crisis. It really was a global pandemic and a forced shutdown by governments around the world. So where are we? Well, one, cases are trending downward, which is really great to see globally, and deaths, as you would expect, are trending downward as well following cases. There's still a long ways to go. We're not out of the woods, but some good news there after recent spikes during the holidays. From a vaccine perspective, also really good news. Here we see doses per day continuing to trend higher. As of yesterday, the 7-day moving average of doses was about 1.8 million doses per day in the U.S. That would take about, at that rate, it would take about 7 months to cover 75% of the population with a 2-dose vaccine. But we know that this rate is likely to continue to improve. One, both Moderna and Pfizer, their production is increasing. I was just looking at allocations this morning. Pfizer is expected to deliver more next week than this week. So that's one. Two, distribution is improving, not just at the state and local level, but also through retail pharmacies. That has been a real issue in terms of getting the shots in arms. We have tens of thousands of pharmacies. As they receive shots and that program ramps up, that's important. And then finally, Johnson & Johnson. Johnson & Johnson received emergency use authorization this weekend. They are delivering roughly 4 million doses this week. No doses next week, but they are promising roughly 20 million doses in the month of March. So sometime late in March, we're getting an additional large chunk of doses from Johnson & Johnson. Importantly, that is a one-shot vaccine. Transportation in terms of cold storage is not nearly as restrictive as it is with Pfizer and Moderna, just regular refrigeration. And Johnson & Johnson expects production to continue to ramp to roughly 100 million doses by the June timeframe. So we are in a world, and if you listen to experts, sometime late April into May, supply and demand really start to come far more into line than where they are today. What does that mean? Well, in terms of herd immunity in the lower right here, if all goes to plan, right, and there's a lot that has to go right, distribution, further approvals potentially from other vaccine makers, and not just distribution, getting the shots in arms, and people being willing to take the shot, there is a world where by late summer you've reached something like herd immunity. There are variants, there are things that are going to potentially cause issues, but there is a chance at herd immunity by late summer if vaccination remains on track. With that, I'll pass it to Brent to discuss the consumer.
Great. Well, the longest economic expansion in U.S. history, which really ran from June of 2009 all the way through February of 2020, gave rise to the best labor market in over 50 years. We added back almost 25 million jobs. That's nearly 3 times more than what we lost during the great financial crisis. The unemployment rate fell to an all-time low of 3.5%. And at the peak in February, we employed 152.5 million workers, the largest in U.S. history. And then COVID-19 struck. And in only 2 months, we lost 22.4 million jobs. It was the largest contraction in the labor force that we'd ever seen. The unemployment rate spiked up to almost 15%. But as the economic recovery has gone on from April through January, the U.S. has added back about 12.5 million jobs, a little bit more than half of what we lost. The unemployment rate has now come down to about 6.3% from a high of 14.7%. But folks, the rest of this recovery is likely to be very slow. More than 70% of the residual 10 million people out of work have been collecting unemployment insurance for more than 15 weeks, which is putting us dangerously close to the definition of permanent unemployment. And as Phil mentioned, the jobs report is coming on Friday. Consensus is expecting about 200,000 jobs to be added. Again, that in a normal month, that would be a stout figure. But when you have a deficit of 10 million workers, 200,000 jobs is a drop in the bucket. This morning, we got the ADP employment report, which was significantly below expectations. So it'll be interesting to see what Friday brings. So despite the labor market woes, U.S. consumers' financial statements are actually broadly okay. And when I look at the balance sheet side of the equation, I look at net worth. So think your net assets minus your net liabilities. We are at the highest level ever recorded in U.S. history, and that's an inflation-adjusted number. So we as a nation are the wealthiest that we've ever been. On the bottom right, when I look at the P&L side of the equation and I look at liabilities, if I look at your debt payments as a percentage of your disposable income, so think what you owe every month divided by the money that you bring in every month, we're at one of the lowest levels in nearly 40 years. Now, certainly that's been buoyed by low interest rates and stimulus payments to consumers, but by and large, it's been trending down for a bit before this pandemic and before stimulus. One of the reasons that net worth is where it is that the median home price in the United States, which is arguably the largest asset on the balance sheet for most consumers, hit the highest level ever recorded since they began tracking this data all the way back in 1987. So when we look at that Case-Shiller 20-city home index of that median home price for the homes in those 20 cities, highest ever recorded. On the bottom right, for the people that don't have a house and those that have been renting, there's been a lot in the press about people not being able to make rent payments and moratoriums on evictions. But by and large, when you look across the United States, in excess of 93% of Americans who rent have been making their rent payments by the end of each month. Upwards of almost 88% of renters have been making their rent payments by the 20th of the month. So even though we need more stimulus, we believe, for consumers to get us to the other side, by and large, keeping a roof over our collective heads, renters and homeowners have been doing a great job. So the real juggernaut, folks, for U.S. GDP is consumption. In excess of 2/3 of U.S. real GDP is what all of us on this call spend every single month. We had an enormous recovery from April all the way through October, but then we got into a little bit of a downturn in November and December as that second wave of COVID-19 struck. But as we got into January, we saw consumption and spending rise pretty significantly. It certainly was helped by the $900 billion of stimulus and the checks that were cut on December 27th. But the one real interesting note is that while consumers unequivocally need the stimulus, the U.S. savings rate jumped from a little bit over 12% to an excess of 20.5%. Total U.S. savings right now today sits at $2.33 trillion, or $1.3 trillion higher than 2 months ago. So the empirical data actually tells you that more consumers put that check that they got in December into their pockets and did not spend it. That's going to be good as we go forward and think about spending in subsequent months, that we have that ballast behind us. So when you talk about what we're actually spending on the top left, a vast majority of consumer spending, as you could imagine this pandemic, is spending on things. I can't tell you how many times I've tripped over multiple Amazon boxes walking out of my front porch. But spending on goods is back significantly above pre-pandemic levels, and the trend is exceeding the pre-COVID trend on spending. Where we're really deficient, everybody, is on the services side of the equation. And you can see on the bottom right, while we had a little bit of recovery from April to June, we've had a tick back down in the summer, and actually spending on services continues to lag. So when we think about what that will affect inflation, and we'll get to that in a bit, I put here the disposition of what actually makes up U.S. inflation. And what you can see is that almost 2/3 of U.S. inflation is services inflation, and only about 1/3 is goods inflation. So when you see the recovery that needs to take hold in things like travel and leisure and airlines and hotels and restaurants, we're going to see an enormous base effect as we try and get back to that pre-COVID trend. So that's likely to exhibit short-term trends for services inflation over the next year or so.
Let's turn for a moment to corporate earnings, obviously really important for not only the stock market, but for markets around the globe, in addition to U.S. stocks. So what do we expect? What do analysts expect? So after a drawdown in corporate earnings in 2020, as you can see in the red bar here, consensus, and we agree, expects earnings to hit a new all-time record in 2021 with higher levels in 2022. The previous record was 2019. So we really are back above pre-pandemic levels from a corporate earnings perspective, which helps to explain why the market has done what it has done in terms of its recovery. Some good news, percent of S&P 500 companies beating earnings estimates has been really high. We're wrapping up fourth quarter earnings season. Companies beat not only on earnings, but importantly on sales as well. And we're seeing upward earnings estimate revisions, as you can see in the lower right. So we are seeing momentum from earnings, and we need that. We need companies to beat earnings as we move forward. And the reason is valuation. Here we're showing forward price to earnings ratio. This is what dollar amount is an investor willing to pay for $1 of earnings, right? This combined with earnings growth expectations, dividend growth expectations are what very important in terms of estimating where the market's going to go. The thing with PE, or the price to earnings, is it's the most difficult part to predict. It is the animal spirits of the market. It can swing very widely. One thing you'll notice here is that the market rarely trades at that long-term average. It is elevated today. In past periods, it has been well below the average. The truth is, it can stay above average or below average for a number of years. It doesn't just immediately mean revert to that average. An example I like to give is former Chairman Greenspan gave his famous tech bubble irrational exuberance speech in late 1996. The market didn't peak until the year 2000. So he was right. He was eventually right, but it just took a number of years before he was. It does not mean the market will mean revert immediately. There are a few factors that help to justify elevated valuation. One, and a lot of this we'll discuss more in a moment, is fiscal and monetary stimulus. You have a lot of cash coming into the marketplace, that pushes up valuations. Two is TINA, or there is no alternative. Rates have moved upward recently, but still low by any historic standards, and that makes stocks potentially more attractive versus bonds. And then finally, low inflation. Where we are in terms of inflation between 1% and 2% historically has indicated a higher PE. And by coincidence, that level is basically right where we are today in terms of 21.4 forward earnings. So when you think about the amount of cash coming into the marketplace, low inflation and low rates, the valuation numbers start to make a little bit more sense, at least in the near term. Speaking of inflation, let's turn to Brent to dig in further on interest rates and inflation.
Yeah. So I think all of us know that interest rates are low and yields have fallen. Hopefully, many of you have taken advantage of this and refinanced your home. You're probably looking at the yield that you get on your money market mutual fund or in your bank account and realize that they are incredibly low. But I think a picture is worth 1,000 words to show you the underlying magnitude of how far we've come over the last 40 years. So back all the way in September of 1981. It's hard to believe given where we are now, but the 10-year Treasury yielded an astounding 15.8%. And from September of 1981 all the way through August 4th of last year, we fell from 15.84% all the way down to 0.51%, which was the lowest level in over 200 years for the U.S. Treasury. And when you think about it, when yields fall, bond prices rise. So if you think about what bonds have done over the last 40 years from a performance perspective, the U.S. aggregate bond index, which is a nice proxy for taxable fixed income, annualized at an astounding almost 8% return per annum for 40 years. At the same time, stocks, represented here by the S&P 500, did about 12% per year. So think about that from a portfolio construction perspective. So whether you are 80% stocks and 20% bonds, or 20% stocks and 80% bonds, you had a very high nominal return and real return over this period. So in response to the crisis, the Fed brought their rate, the Fed funds rate, basically and effectively to zero. Right, we heard Fed President Jerome Powell speak as recently as last week that we are still a long way from a labor market recovery, and we're a long way from the 2% rate of inflation that the Fed is targeting. And they're likely to keep rates near zero for a prolonged period of time. And if we look at the Fed's infamous dot plot and their expectations for the future, the Fed is expecting to keep rates near zero through the end of 2023. And if you read into what Jerome Powell said last week, the Fed reemphasized their narrative of they're not even thinking about raising rates. But the interesting thing that actually caused markets to go a little bit sideways last week is that market participants are actually pricing in that the Fed will raise rates sooner than we all believe because of the robust economic recovery. And right now, interest rate swaps are pricing in about a 25 basis point hike in March of 2023. So still far away from seeing a rate hike, but a sign that the economic recovery momentum is going. And right now, even though the Fed's keeping rates near zero, interest rates and rates are already moving. When we look at the top left and we look at the spread between 2-year bonds and 10-year bonds, which is sort of indicative of what we'll call the steepness of the yield curve, we're at a 4-year high. And if I update this on the fly for where we are right now, we're at about 1.34% spread. So getting steeper every single day. And on the bottom right, from 51 basis point yield back in August of last year, we hit as high as 1.61% on the 10-year Treasury last week. Today, rates or yields are back up again. Today, we're sitting at about 1.48% right now today. But folks, we are still a long way from where we were pre-pandemic. We were sitting at about 1.92% yield in January of 2020. It's still going to take quite a long way for rates to rise to crowd out equity investing. So still a far way away. So one of the things that's really important to understand is how rising rates affect returns on bonds. And an important concept that you need to understand is the concept of duration. And in essence, the longer the duration of your bond, the more sensitive its price is to movements in interest rates, right? So, and vice versa. And when you look at almost every bond index that's out there, here on the left, we're looking at the investment grade corporate bond universe. But if I looked at the U.S. aggregate bond index, the BarCap intermediate government credit, the Barclays municipal 1 to 15 municipal index, all of them have seen their durations extend to the highest level that we've seen in over 30 years. So what that means in English is that many bond indices today are the most sensitive they are to changes in rates than at any time in the last 30 years. And you can see on the right side of this slide what the price impact and total return impact would be for a 1% move up in rates from here. And you can see in the bottom part of this slide, year to date, whether you look at taxable bonds, corporates, or municipals, rising rates have caused bond prices to fall. So one of the narratives that's been floating around on the financial news media is that rising rates are crowding out stock investment and that rising rates are going to have a negative feedback loop to corporate earnings and profitability. It sounds like a great narrative. Unfortunately, historically, it's just factually inaccurate. If I go back over the last 30 years and look at all 7 of the last rising rate environments, the S&P 500 has demonstrated a positive return in 100% of those 7 interest rate hike cycles for an average return of 17%. So again, past is not always prologue, but at least in every single rate cycle over the last 30 years, stocks have not been crowded out. Corporate earnings and profitability wasn't significantly or materially compromised, and stocks did well in a rising rate environment. So let's get to the $64,000 question of the day, and looking through a lot of the questions that many of you submitted to us in advance, and thank you for that. Lots of questions on the effect of monetary and fiscal policy stimulus and the effects on inflation. So let me try and get to the bottom line and summarize it here. We believe that all of this pent-up demand that we were talking about earlier in the presentation will absolutely cause inflation in goods and services in 2021. But folks, that is a base effect. So think about this almost mathematically. If I have $1 and it falls to 70 cents, and then it goes up 10% from there, 20% from there, you've significantly risen from that low point, but you're nowhere near back to even, right? So with all this monetary and fiscal policy stimulus, we will absolutely see a resurgence in inflation, but we're still not back to pre-COVID levels of prices on both services and goods. And when you listen to Jerome Powell and the FOMC and their views, and I'm going to show you a slide in just a second on core inflation, the Fed believes that inflation expectations will remain anchored, and they're asking market participants to effectively ignore the inflation spike that we're going to see in 2021. And when you look at the historical data and the tools that are in the toolkit for the Fed, you almost have to take Chair Powell at face value. And remember, folks, it is much easier for U.S. and foreign central banks to act on inflation spiking and rising than when you get into disinflationary tendencies and deflation. And one of the big longer-term impacts that we've already seen from an inflation perspective with all this monetary and fiscal policy stimulus is asset price inflation. I just covered where U.S. homes are. Significant rise, 10.4% year over year. Stock market has been up significantly, right? So by and large, monetary and fiscal policy stimulus, while it does have this base effect on services and goods, it definitely feeds back into asset prices, think homes and the stock market. Longer term, though, high debt levels do not necessarily lead to higher inflation. A perfect example of that is Japan. They hit almost 300% debt to GDP, and they can't find inflation with a flashlight. So at the end of the day, it is a fallacy that high debt levels and high fiscal imbalances necessarily translate to longer-term inflation. And when you look at the last 25 years in that white line, core inflation has not materially exceeded 2% in over 25 years because of the toolkit that the Fed has and the fact that when you kind of take out the more volatile components of energy and food, underlying baseline core inflation has been remarkably stable. So we're going to transition and we're going to talk about where do markets go from here. Phil's going to do a quick synopsis of 2020 and some of the uniqueness there, and then we're going to dive into the short-term and long-term outlook for stocks in the market.
Great. So let's look quickly at 2020, really a year I won't forget, and I assume many of you will not either. As you're all very aware, in the first quarter, severe 34% decline in the S&P 500. That is only the 6th time that we've seen a greater than 30% sell-off since World War I. That alone is a rare event. Importantly, it was also the fastest 10, 20, 30% decline ever. So it felt really sudden. It was the fastest ever. What's really incredible is the degree to which the market recovered as it looked ahead to hopefully reopening. Impressively, after 3 quarters of gains, the S&P 500 ended the year up 18%. So think, you have a 34% decline and still somehow on a year-to-date, full-year basis up 18%. It really was a story of mega caps. So the S&P 500 as a total rose 18.4%, as I just said. If you take out the largest 10 names in that index, and you have S&P 490 left, that index only rose 3% last year. Those largest 10 names, so you think Amazon, Google, a lot of companies that benefited from people staying from home, large tech companies particularly, those 10 stocks rose 43%. So the overall market 18%, everything but those 10 stocks only rose 3%, and then the top 10 rose 43%. We have started to see a rotation there. Late last year and into this year, the Russell 2000 small cap stocks has materially outperformed large cap stocks. Why is that? Small cap stocks look more like Main Street. So as the market is looking ahead to reopening, it has rewarded smaller stocks that can benefit from that. So we are seeing some rotation there. But last year was all about the biggest companies driving returns. Also at the industry level, what we saw makes some sense. Stay at home and work from home themes outperformed. Online retail, information technology, home improvement, groceries. It makes sense, and it really did work. I mean, the market was behaving somewhat rationally on trend. And those industries that underperformed also make sense. Energy, right? When you think about the price of crude oil crashing and gas prices, airlines, hotels and cruise lines, they underperformed. So it does make sense what we saw. And we are starting to see rotation here as well. The number 1 sector in the S&P 500 year-to-date this year is energy. So some of this is reversing as we move into 2021. And any year-end gives you an opportunity to sort of reflect back. So if we look at the 10 years ending on December 31st of last year, of 2020, on average, the U.S. Large cap stocks, S&P 500, averaged 13.9% gains annually. That is high, or sounds high because it is. On average, if you look at the lower right, the rolling 10-year returns since 1925, 10.4% average. The last 10 years, on an annualized basis, outperformed the long-term average by 3.5%. When you look at 15 years, that was 9.9. 20 years, 7.5. The last 10 years really were incredible, something to celebrate. But as we look forward the next decade, it's unlikely that we keep this sort of pace forever, just as the last 20 years would indicate. With that, I'll pass it to Brent to discuss some catalysts and what we see moving forward.
Yeah. So the reason you saw the numbers on that previous page is because markets have been driven, and we believe will continue to be driven from now through the end of 2022, maybe the first half of 2023, by these 2 big fundamental catalysts. The first is unprecedented monetary and fiscal policy stimulus. And to put this into perspective, so far today, we've had $3.28 trillion of fiscal stimulus off of a base of about $21.5 trillion of GDP, 18.8 if you're looking at real GDP. That's coming in at roughly almost 15% of U.S. real GDP in stimulus so far. We have another $1 to $1.9 trillion of stimulus that's literally being voted on as we speak. We believe it's likely going to be larger, not smaller. If that goes through, which we think it will, that will bring total fiscal stimulus to roughly between 20 to 25% of U.S. real GDP in stimulus. On the monetary policy side, I already told you that the Fed brought rates effectively down to 0. They're likely to keep those rates low for an extended period of time. The Fed is also expanding its bond buying program. They're buying $120 billion a month in bonds, about $80 billion in treasuries, and about $40 billion in Fannie, Freddie, Mac, mortgage-backed securities. The balance sheet for the Fed has ballooned from a little bit less than $1 trillion in 2007 all the way to an astounding $7 trillion today. And with that additional bond buying is going to go to as much as almost $9 trillion by the end of 2023. That unprecedented wind behind the sails of the market is likely going to keep things going for quite a long time. The second big catalyst is really that all of you as investors demand a positive real rate of return if you're going to subject your hard-earned money to risk by putting into the market. Well, I'm going to try and make investing really simple. There's 4 buckets that you can put your money into. You have cash, you have global bonds, you have global risky assets, so think global stocks of all size and style, equity like fixed income, currencies, commodities, etc., and then private investments. Well, 2 of those 4 buckets are basically giving you today either a negative real rate of return or a 0 or barely positive real rate of return. The median money market mutual fund today has a yield of 0.01%. Virtually all G20 sovereign bonds, U.S. included, have a 10-year bond yield that is at or below their either current or forecasted rate of inflation. And even in investment-grade corporate bonds, we're sitting at only about 0.9% yield over treasuries. So sitting at about 2.3% yield, which while above current inflation is basically only about 10 basis points above expected break-even inflation. So 2 of your 4 buckets are basically giving you no real return. So that is forcing global investors to put more of their money into risk assets than they would otherwise to compensate for that dilemma. So this is an interesting quote that the European Central Bank actually tweeted out on Valentine's Day. They said, roses are red, violets are blue. We'll keep financing conditions favorable till the crisis is through. Folks, you can't make this stuff up. This is a major European or major central bank, global central bank, telling you that they're going to continue to flood the markets with stimulus. And then when you add that to what I have on the bottom here, where you think about of that $3.28 trillion of stimulus, $700 billion of that is still unspent. We're going to have another 1 to 1.9 trillion for Biden's phase number 1, potentially another $2 trillion in infrastructure spending. And as I said earlier, we have a $1.3 trillion excess of personal savings over and above the level that we had some 2 months ago. So think about that tidal wave of stimulus basically inflating the sales of the markets for some years to come. So let me get to the bottom line on where markets go from here, and I'm going to break it into 2 buckets. Number 1, we have been and are cautiously optimistic on stocks in 2021. But folks, a lot still needs to go right, as Phil Neuhart talked about. We still need to make sure that vaccine distribution and inoculation keeps going without a hitch. We need to see corporate earnings and profitability continue to exceed expectations and not trend down. And we can't see any fundamental wavering in fiscal and monetary policy stimulus. Right now today, the consensus of 73 Wall Street firms expectations for the S&P 500 on a rolling 12-month basis from February 26th of 2021 through February 26th of 2022 is calling for 4410 on the S&P 500, which is about a 15% return from Friday of last week until the 26th of February of next year. So let me boil it down where I think markets are going to go over the short term. We believe that these 2 fundamental catalysts, monetary and fiscal policy stimulus, as well as TINA, or an acronym for it, there is no alternative, is going to continue to drive markets from today through the end of 2022, maybe if we'll get lucky through the first half of 2023. But then, if you think about it, the next decade's returns, as Phil highlighted, we believe are likely to be much, much lower than the previous decade. Because remember, markets are an expectational pricing mechanism. They more often price in what is expected to happen versus what actually is occurring. And what the markets are going to have to deal with in the second half of 2023 is the withdrawal and reduction of all that fiscal and monetary policy stimulus. And as Phil highlighted in the opening part of our presentation, the consensus expectations for growth in 2023 is back down to 2.5%. So that fiscal and monetary policy stimulus after the economy in the U.S. has already recovered needs to be dealt with. By then, we'll have higher interest rates that we, by then, believe will start to offer choice to risky assets, and then you'll start to see the unwinding of that TINA trade. And then, as Phil mentioned, high stock valuations today are likely to manifest themselves somewhere lower in the future. So, as Phil talked about, we're trading at about 22 times forward earnings today. We don't believe that they're going to revert back to the 16.5 times forward earnings. That's a 50-year average, nor at 32 times trailing like we are today are we going to get back to the 70-year average of 17.9. We're still getting ourselves to a lower growth rate beyond this recovery in the economy. So the big question is, how much will market participants be willing to pay for $1 of earnings? We believe it's going to be somewhere lower than where we are today, but not where historical baselines are. So you're going to have multiple contraction over the next decade, which will take away from S&P 500 growth in the previous decade. So let's talk about the short term. This bull market historically is very young and still low returning. We're almost 1 year into this, only up about 77%. The historical average for bull markets is a little bit over 5 years and a return of 183%. So historically speaking, very young. This next slide is what I think is probably the best to think about for the short term. Is we're just about right on March 23rd, we're going to be starting the second year of a new bull market. So what you're looking at on this slide is on the far left-hand column is every bear market low post-World War II. The second column is what happens in the first year of a bull market. And you can see that second to last entry, we're up almost 75% in these 11 months. The good news is that year two of a new bull market, while harder than year one, is not really so bad. And what you'll see is that 100% of every second year of a bull market has been positive for the S&P 500, 100%, for an average return of 12.7%. But the thing that I really want you to focus on is that far right column, which is that in the second year of bull markets, the average intra-year drawdown has been almost 10%. And if we use a perfect example of the recovery post the great financial crisis, you can see first year you're up about 69%. The second year returned 15.7%. But in that year, you had a peak to trough drawdown of 17.1%. So what I'm trying to tell you folks is we will absolutely have volatility this year. Do not let that shake you out of your financial plan and staying invested in the markets, because historically the second year of bull markets has been positive 100% of occurrences, at least historically. And you can see if I look at years post-presidential elections, which we just had, you can see the inherent volatility. You can see I put a little arrow on, we are roughly here. You can see that this year is following almost verbatim of the 70-year historical average, and we're likely to see a resurgence in equity markets from mid-March through May, and then up and down, sort of like a seasick roller coaster, finishing the year positive, but a lot of volatility along the way. So let's talk about forward-looking expectations, and the bottom line is that expectations for the next decade are likely to be much lower. And what we're looking at here is the consensus of 39 major Wall Street firms and large global banks and their expectations for returns for stocks and bonds over the next 10 and 20 years. And if we look at just sort of that first line item of U.S. large cap stocks, the expectation is for about 6.2% per year over the next decade. If you compare and contrast that to what Phil just showed you, that's about 4.2% lower per year than the 95-year historical average, and less than half of the returns that you got over the decade that just ended. One of the things, if we get back to valuations on the next page, Phil, Robert Shiller, the Nobel laureate, has an infamous valuation ratio called the CAPE ratio, or cyclically adjusted PE ratio. In English, all it is the price of the S&P 500 divided by 10-year trailing earnings that are inflation adjusted for the business cycle. That gauge just passed the high level mark that we saw right before the Great Depression in 1929, and has only been higher 3 other times in history, in 1999, 2000, and 2001. This ratio has been notoriously bad in predicting short-term performance. But when you look at its predictability over the long term, it's been a very accurate predictor of longer-term, decade-long performance. And you can see on the dotted lines here and to the right, the 3 observations that we had that were at a higher point than where we are all had decade performance that produced a negative real return. You can see in there close to that dotted line, 98, 2002, and 1929, all had very, very low real total returns in the subsequent decade. So if you flip to the next page, Phil, and you look at the last time this happened, which was 2000 to 2010, the S&P 500 was negative from a price perspective, did about 1.4% per annum because of dividends. Inflation was running at about 1.8%, so you had a negative real return. So does all of this mean that you should be getting out of stocks? The answer is no, 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 no. The answer is you need to diversify your stock holdings. During that period of time, small cap and mid cap stocks, as well as developed international and emerging market stocks, did 4.5 times the return of the S&P 500. Mid-cap and small-cap value stocks in the U.S. did almost 6 times the return of the S&P 500. So the 2 big takeaways here is history rarely ever repeats itself. And secondly, is that you need a team of people that is building portfolios for you, that uses forward-looking capital market assumptions and dynamically adjusts your portfolios or reviews your portfolios on a quarterly basis, a periodic basis, to make sure that what you own is reflective of what's coming down the pike for you. So we're going to stop there, and we're going to open it up to some questions. Amy?
Hey, thank you so much. I'm Amy Thomas. I'll be moderating the Q&A portion of the event. Brent, so we've got so many questions in. One I want to be sure that we get to is on the credit markets. It just came in just a few minutes ago. Have you seen a behavior in credit markets that signal a decline in default risk premium? Why might that be?
Yep. So the answer is no. We have not seen that, right? So while credit spreads have absolutely tightened and sitting, for investment grade at about 90-ish basis points over treasuries, and for high yield about 350-ish, we have not seen a material uptick in default, either in the investment grade space nor in the sub-investment grade space. And, likely similar to what we had coming out of the great financial crisis, we started to see corporate defaults some 12, 18 months after the market had bottomed on March 9th of 2009. So you're likely to see a modest tick up in defaults, but by and large, with all of this monetary and fiscal policy stimulus, PPP, and the fact that we're seeing a much more robust economic recovery much quicker than normal, we're likely to see a lower level of defaults than we saw during the great financial crisis.
Thank you, Brent. I'm seeing a lot of policy questions come in. What are your thoughts around the retroactive taxation in 2021? Is that something we might see, or will it move to 2022?
Yeah, it's a great question. So fiscal stimulus is going to be contentious, right? You're looking at an eye-popping $1.9 trillion in fiscal stimulus that's being proposed. There's a lot of contentious elements to that. Think about the state and local funding that's built into the bill of about $350 billion, 195 directly for states, 130 for local governments, and about 25 billion for territories and tribal, right? When you only had, in fiscal 2020, you only had a $31 billion revenue shortfall across all states in the United States, right? So you're talking about stimulus that's being proposed 6 times the shortfall that we saw. And 2020 was the first time in 42 years that state and local budgets actually had a budget surplus. First time in 42 years. So there's a lot of contentious things that are built in, but by and large, you're likely going to see tax policy needing to be built into this fiscal plan in order to subsidize that, whether that's on the personal side or on the corporate side. I tend to think it's going to be more on the corporate side than on the personal side. But if you listen to Dan Clifton when he had him on, going back over the last 6 times that we had a major tax policy change, only 1 out of 6 times was it retroactive back to $1 and to month 1, and that was in 1993. So if history were to repeat, Amy, unlikely that it would be retroactively applied. But hey, look, never say never.
Thank you, Brent. We have another couple of questions coming in around regarding the deficit. This one's actually a 2-part question. What is the economic impact of the $1 trillion deficit for the long and short term, specifically dollar standing in the world reserve currency? And the second part of that question is around workforce futures, considering the possibility of a minimum wage increase.
Yep. So Phil, I'll take maybe the second part. You want to jump on the first part?
Yeah, so it's a great question. We hear a lot in terms of deficit. So I'll give you sort of the textbook answer and then sort of what we see in the real world as well. So textbook answer is when you run really large deficits, it lowers potential output, it lowers potential growth. And the reason is those huge public deficits crowd out private investment. So big deficits, private investment, private entities save to cover for the debt for public debt, and you see less investment on that side. So lower expected growth is what you should expect. And then the second part, the academic answer is you would expect higher rates. And the reason is an investor requires to be paid more for a less creditworthy lender, and in this case, a less creditworthy entity, which in this case is the U.S. government. What we see in the real world, and Brent mentioned it before, is Japan, right? Which is huge deficits. They have had very low growth, but low rates and low inflation as well. And the reason is that rates are pricing in both growth and inflation expectations. And if you are in a lower growth period, it's not guaranteed that rates go higher. That does tie into the idea of being the reserve currency. Japan is a reserve currency. In Asia, we are a reserve currency in at least half the world, I'd argue, the whole world. That's unlikely to change anytime soon. So if I'm a betting man, what it does is it lowers potential output, the large deficits. It is a weight on growth. It's very hard to put a number on that, but it is a weight on growth. And we actually have low rates for longer. Rates can rise from here and still be historically low by any metric. And additionally, inflation remains low. How do you get your way out of it? Well, the way you get your way out, you grow your way out of it, right? It's innovation. I do think us sitting here in the States can take some solace from what we saw last year, the amount of innovation coming out of this country, large tech companies, what they have been able to do. The fact that we're sitting here doing a video call right now, we are seeing some, I think, early signs of productivity growth and innovation, which can get you out of these longer-term problems that, say, a Japan has had.
Yeah. And there is a benefit, Amy, right? So from the bottom of the crisis, right, so from March 20th of last year to today, the dollar has fallen 14% relative to a developed and developing currency basket. That's actually an additional tailwind for the U.S. economy, because you think about our dollar when it comes to services and goods is cheaper today than it was, almost a year ago. So that's going to continue to buoy the economic recovery in the United States.
Thank you for that. Bill, we have another question. I know you and Brent both covered the Federal Reserve quite a bit. Isn't the Fed dramatically downplaying the onset of rapid inflation, given the unforeseen run-up of interest rates?
Right. So it's a great question. Something that really transports my mind back to the Great Financial Crisis. So that was the first time the Fed had ever instituted quantitative easing. We saw an explosion in the Fed's balance sheet, much like we've seen now, and any shop you were in said, wow, inflation, interest rates are going to go up. The exact opposite happened. What we actually had was really a Fed fighting deflation, inflation remaining low, as Brent outlined in some of his slides, and interest rates continuing to fall. I think, one, the Fed is never going to come out and say we're worried about inflation, because that would create an inflationary spiral. But two, I think the Fed knows that they, as Brent alluded to, can attack inflation much easier than they can attack deflation. And they want to make sure that this economy is on track before just assuming that inflationary pressures are here to stay. Brent alluded to, it's just true, you are going to see some year-on-year inflation gains in coming months. Why is that? Think about where gas prices were at the bottom of the pandemic. So year-on-year, it's going to look like a jump. The Fed is more worried about sustained core inflation, so inflation minus energy and food. And I think that they honestly have their finger on the pulse. I don't think we're headed for a severe inflationary spiral. And if we are, the Fed's going to act. They will. This is not the Fed of the 1970s. They will attack inflation and put us in a recession before they let us exist in a sustained stagflationary environment.
Thank you, Phil. Brent, I'm seeing another policy question come in around the likelihood that the administration will pass an infrastructure bill through Congress.
Yeah, so it certainly is a bipartisan discussion, but the problem, though, is how do you pay for it, right? So we already have a $1.9 trillion fiscal stimulus on the table right now, and potentially another $2 trillion on top of that in infrastructure. Interestingly enough, as part of the $350 billion of written legislation by the Democratic House right now, there is no specific definition as to how states are required to use that $195 billion of stimulus, nor are local municipalities basically told how they need to spend that roughly $130 billion. So you're likely to see some of that stimulus that might be worked into that first round of fiscal stimulus used for infrastructure. It'll definitely be a contentious debate. I think the biggest roadblock to seeing infrastructure go from here is really how do you actually pay for it? It'll be interesting to see. The only way you can logically think about that is through higher personal and corporate taxation to be able to fund that type of an infrastructure bill.
Thank you, Brent. I've got a couple more minutes here. There's a question out here about retirement planning and getting ready for retirement with all the volatility in the world. What are your recommended actions for someone who's planning to retire in the next couple of years?
Yeah. The first thing is, if last year didn't emphasize how important it is to have a financial plan, I don't know what could help you, right? So thinking about the inherent volatility in markets, where we are, and then the volatility of volatility, the speed of the ups and downs is at the fastest level ever recorded in markets. I would say for someone that's nearing retirement, getting ready to get into retirement or in retirement, you need to have a comprehensive financial plan. So that's number one. Number two is we wrote a piece called How Not to Be Eaten by a Bear. It kind of lays out how to think about investing between now and the next 5 years and then 5 years after that and thinking about what you need. So the combination of those two things, Amy, but most importantly, sitting down with us, sitting down with a financial planner to make sure that your portfolio is allocated and it's congruent to the rate of return that you need to achieve both now and the future, and you have enough cash reserves to make sure that you can weather ups and downs, is worth its weight in gold. So make sure you talk to a planner.
Thank you, Brent. Thank you, Phil. Thanks so much for everyone who submitted a question. We're right up on the hour, so I'm going to pass it back to Brent for any final thoughts. Thanks, everyone.
Well, I want to thank everyone for being on the webinar today. As Michael said at the beginning of today's call, we strive to bring you up-to-date information surrounding markets, economic events, and policy changes. If your question wasn't answered, we will make sure that we get back to you with an answer through your First Citizens Bank representative. But as part of our ongoing effort, I'm happy to announce that we'll once again be joined by Dan Clifton from Strategas Research Partners on April 6th. As many of you know, Dan and his team are industry leaders when it comes to the relationship between politics and the economy. Our Director of Wealth Planning, Neri Shirai, will be holding a call on April 6th to get Dan's best thinking on tax policies under the new administration and this divided Congress. You don't want to miss that one. We're going to have more information for you on the coming days about how to register for that event. As always, thank you very much for your time today, and have a great rest of your day.